So, after the Fed did their quarter point expected rate cut and the markets had a little time to digest it, it sure looks like at least the NASDAQ is ripping higher. So, I'm going to tell you what I think going forward. Stick around, should be a great video. Hello, my YouTube friends. My name is Adam Kahn, and this is Investing with Adam K. Hope everybody's having a good day. It's really amazing how, in a bull market, any idiot, even me, can look like a genius. As stocks go higher and people make picks and they go up, it's very easy to look like, oh, I'm so good at this. And what do I expect going forward? What I really hope is that this is the equivalent of 1998 and we're just beginning to go parabolic. I know that sounds nuts, and market's already stretched. I recognize that. I think the analysts have a lot of good points. PE ratios are high, things seem overpriced, and I actually worry that the ETFs, the ones that I even love, like VOO or SPY, like the S&P 500 type of ETFs, I worry that they could be the culprits in the end of what actually drives it too far. And I'll explain that as we move along as well. And the funny thing is, I'm super bullish at the same time of wanting to be cautious, because what I think is we're already in overvalued territory. And I do not think that this time is different, and that just means that PEs are going to get extended and we're in new era of life and just to expect that. What I kind of hope for, because it gives me an opportunity to have one last chance at possibly a really big trade, is that we go irrational exuberance, as Greenspan said back in the mid 90s to late 90s. If I remember correctly, when he did that famous speech, he was 2.5, maybe 3 years early before the markets topped out, and they pretty much doubled or more from the time he said that. Before the NASDAQ corrected, are you ready? Over 80% from the highs. It traded over 5,000 to go back down under 1,000. And it wasn't like COVID. This took time. It wasn't over a long period, but it wasn't over a short period like COVID where it just went down and straight back up. And the back up took a long time too and was very tough. It was not a very easy trade. So I say it with caution that I hope the market spikes higher. And here's the things to look for. You start looking for people who don't invest in the market talking about some crazy stock. And I'm guessing this time it will be things in AI. Companies that have no earnings, that are just stories that sound great, that start out at really low prices. Maybe they're IPOs that show up on CNBC that just shoot higher when they get the advertising of being on CNBC, with no earnings, no promise of a future, just a great idea. That's what I'm hoping to see. And then when I go to parties or when I check in places or when I go out to dinner, people talking about all of these crazy AI stocks that really haven't amounted into a real company yet. What causes that is the market going up so much that people start to hear about how much money people are making. If Amazon is trading $500 in 2 years, well, other people are going to get jealous, and that's what's going to draw them into the market. And don't hear it the wrong way. I would almost like anything is okay. It is a healthier market if things slow down now. You see some pullback and forward, and we just continue chugging along at an 8 or 10% per year increase of value in the market. But if it really starts to spike and disengage from reality, be careful, and it will go further than you expect. Like that's really what happened in the late 90s to 2000 before we had the dot-com bubble. And it's the same type of thing. That irrational exuberance comes from what we call FOMO now, but all that fear of missing out, but it's really just seeing other people do really well in something and coming in late to the party, driving too much money in something that people aren't really getting in and out of. And it's supply and demand forcing the market higher, but to the point that the price to earnings and the values don't make sense. It takes something you understand, that you know that the value makes sense of, and then drive that price up 20 times higher than what you know it should be worth. And eventually it's going to come down. And when it comes down, it's going to go down too far as well. The other thing that helps cause this is the pullbacks like we had in April. When you have a really good downturn that scares people out to where they cash out of some of their investment and leave that money on the sideline, as the market goes back up and they don't get back in, there's a point where they start to get jealous and they push that money back in. I don't think we're anywhere close to that. It's also why I think we're running higher. But be careful of the morons on YouTube. I really mean it. When they're promising 80% returns per year, or talking about their option strategy without really explaining it and talking about the risks and the negative, I would be cautious of any of that stuff. Stick to your game plan. Know what you know, invest in what you understand, and you know, be a little cautious of what's going on. At the same time, what I've always said is my goal of this channel is to hope that I help people start putting money away for the future, even if things go down. I know that sounds stupid, I get it, but I would rather see somebody invest in whether it's the markets or collectibles or whatever it is they know about to watch the values fall in half but still have money saved for the future than not save and spend it on going to dinner and going out to shows and going to concerts. And I get it, like you have to have a balance of both. You have to enjoy life. You can't simply just put away and put away and put away. But I'll tell you what, as somebody who always was put away, put away, put away, now that I'm 53 years old, I can't tell you how thankful I am that I did that for so many years. I am finally beginning to relax where I don't feel the need to put away so much anymore. And I'm able to go on trips with my family for the summer or whatever it is that have caused me to relax a bit because I did that for so many years. Now, to be fair, the reason I say that is it probably would have been good if I had a better balance and also not just put away, but maybe went to more concerts and traveled more when I was younger, but I'm trying to make up for it now in some ways. I still think I'm really happy because if you do it at a young age, it's hard to explain the compounding aspect, how much it can really grow over time. Because if things grow on average 10% a year, and you go 30 or 40 years out and let it continue to grow and continue to save and put away, it's amazing how it can escalate in speed and value as to make it a big number so that it makes it reasonable to be able to retire and have some passive income coming in to help with whether it's social security or pension or whatever else it is, or potentially you don't even have to rely on that stuff because you've saved enough and were fortunate enough for it to grow. The other thing I personally, excuse me, am doing at times like these is when I really start to diversify a little, spread it into the things that are out of favor too. I know I've talked about Verizon and Conagra, and I've really enjoyed the options trading on it. And this weekend I'll do an update on the one that I'm doing with my son. I hope you guys are excited about that. And really, I'm not super concerned how the account does. I really just want it to do well because I'm hoping if it does well, that gets him more excited about paying attention. Not because I hope that this is what he does for his life, but the reason I want people to learn about finance is I don't want to see them get taken advantage of people because they haven't educated themselves at all on it. Unfortunately, I find in a lot of sales jobs, the salespeople are just salespeople. They don't necessarily understand what they're selling, and sometimes they're just looking out to get their commission and may not be giving people the best advice. There are solutions out there to be able to diversify your portfolio, do it yourself, and if you have the discipline to really just leave it alone and not pay too much attention, you can use the ETFs that I'm going to explain of what I see them as potentially being the issue for the expanded PEs and overvaluation. And I still think they're the right thing to do if you don't want to learn about individual stocks and doing all the research and you don't find this interesting. If you do find it interesting, great. I mean, honestly, I love this stuff. It's why I watch it all the time. It's why I pay attention to it. I've done finance since I got out of college. And oh my God, I'd hate to say the year 1994. Look, I'm old. I guess I do that already. Anyway, that being said, I, I like to look for what I call great companies that are out of favor. Like I often refer to it as bad news on great companies. I know I was banging my hands on the table talking about United Healthcare recently. It's very easy to say it. Like I said, any idiot in an up market can be right on things. But what I look for are those types of companies. I think Target is going to fall into that. It's just harder for me because I don't really see it as a great company. I just think they've gotten so out of favor. I feel like they're still oversold. And you see, I'm still talking about it. I've been talking about it for 6 months, and they've still been out of favor. Uh, I don't know if and when the turnaround is going to come. And maybe they end up being a Sears and just things get worse and worse. And eventually they can't compete with the Amazons and the Walmarts of the world, but I kind of think they'll be fine and they won't turn into a Walgreens or something like that. Is it Walgreens or is it one of the others that really has struggled? But but I think it's enough bad news in a company that has really good earnings that eventually we'll see them turn around. And I'm okay to admit I'm wrong because I never make such big bets that I lay it all on the table where one company is going to just destroy the investments. So part of my point of diversifying. Now, here's what I worry about with the ETFs in terms of the PE expansion. And if we have what I would refer to and others as a melt up, where I see them exacerbating the problem to where things could really run too far. So when you invest into those S&P 500 or the NASDAQ funds, it's a computer algorithm that automatically disperses the money into appropriately weighted amounts. So meaning the largest cap companies get the most money put into them from these ETFs. You with me so far, and do you already see where I'm going? So when you buy, if you put $1,000 into VOO, the appropriate amount for what percentage of the S&P 500 goes into Apple and Google and Amazon, as well as the ones on the lower end of the spectrum, and the exact percentage of their market weight of the S&P 500 where the biggest companies are more weighted. So it continually puts more and more money into the largest companies, causing those PEs to get further and further out of whack. If we go into a scenario like a 1998 to 1999, where the market really takes off and everybody's investing in VOO, SPY, QQQ, QQQM, and SCHD, you're going to see those companies all get overvalued, especially the ones that are the largest, because they're going to have the most money getting pumped into them from everybody buying these safe, well diversified new ETFs. Then, when the correction comes, all that money could come out of it. Now, that is not what I'm saying is going to happen. But if over the next few years you see the market spike up and the ETFs is what everybody's getting recommended into, when it eventually turns, if there is a crash, the big companies are going to come down really hard. Again, I'm still bullish the market, so I don't want it heard the wrong way. And it would be healthier if the market just has some small corrections all along the way. But again, not what I'm hoping for, and I hate to admit, I'm hoping for that big boom and that big correction, because if you're paying attention, it should be really extreme and you should be able to trade accordingly. I'd also be wary of like the craziest stuff is the stuff that's going to run the most. And it's what I'm beginning to see, which is also a healthy environment, so it's very hard to tell the difference. When I'm seeing HIMS run and SoFi and some of the other smaller, crazier companies, even I noticed that, what is it, Open Door, based on that guy who did it with Carvana, is running as well. And even SoundHound, the one that I picked with my son. So as those smaller companies that our hope and don't have the earnings quite yet are the ones really running. They could be the ones that really take off and fly, and people start going, oh my God, this guy made trillions of dollars in this or that or the other, because it's harder to move the mega caps. Still think the ETFs might do it, so keep an eye on all of it. Be a little cautious. Protect yourself by diversifying. Do the things to make sure your portfolio is set up properly. And as always, this is not financial advice. I'm waiting for the rain to come. Please don't listen to me or anybody else on YouTube. You really have to make the right decisions for your own portfolios. You have to do your own research, and you should probably reach out to a financial advisor. If you talk to your accountant or your lawyer about it, by all means, reach out to them. And part of the reason I know I harp on this is the reason not to listen to some YouTuber is your goals for your money is going to be different than my goals for my money. Like, you might be on the in the position to just go hog wild and take all sorts of risks, and then that's great. You have every right to do that. And you may be in the position where it's capital preservation and you don't. What I do for my own purposes is I split it up into different categories for each of those purposes. I've mentioned it many times on the program. I actually have started to open up even more accounts, but primarily with the ones that, so my set it and forget it account, I don't mess with. It is what it is. It's my capital preservation. It is where a majority of my investment is. It doesn't have online access. I can't make trades on it. I have to call somebody and put the trades in. That person knows me personally, so they recognize my voice. They know my number. It's like old-fashioned, late 90s type of account. You can't trade online, can't do anything. I love it. It stops me from being me. It allows me to be invested in companies that I think are really good, in companies that I think are just going to perform over the next 20 years, whether the economy does good or bad. It's what I plan, that hopefully I never have to do anything with any of it, and I can live off of, whether it's work or my investments or other things in the meantime, and it'll be my kids one day. Fantasy world. But then I have a separate account that was primarily dividend stocks that I've started doing some options on, which is what I talked about and mentioned earlier with Conagra and Verizon. And then I have a much smaller account that is my hog wild, trading, crazy, whatever I want to do type of account. And then in that account is the one that I have my position in HIMS and SoFi in, where I've been selling puts and selling calls and really trying to push the limits on it. And it's exciting to do that, and it keeps my brain occupied. But by separating them and having different ones that have specific goals, it allows me to focus on those goals and let the money do what it's supposed to do. And I know that the set it and forget it account is there in the back of my mind, so I can relax when, HIMS was very stressful when it went down to the lows. No matter how relaxed I seem on the videos, when it fell to $40 a share, I was extremely unhappy about it. I wanted to get out. And thank you guys, because these videos helped me to stick with the trade. Because not only did the videos, but also a reminder that I'd put that money in there to allow it to be a trade and to allow it to work out the way it works out, and not to stress so much about the money when I was down what I was down. It's very easy to say it now as it's rebounded, and last I saw earlier today, it was at like $55 a share again, which is great. It means tomorrow, if it closes there, I'm going to collect all the premium from all of the September 19th things that are expiring and be able to sell more options, which is super exciting. And that was my ultimate goal, was to be able to focus on trying to get the returns of the options. But again, my point is, by having that separate account where the focus is on trading and trying to push the returns on those, I was able to relax a bit and recognize and remind myself that was the point of the account. So if it goes wrong and the trade sucks and I lose money, it's okay. I have the other account and the other account to support it. And it helps me, at least. I don't know if that's something that would help you guys, to to actually set up separate accounts with different goals of each of the accounts so that you stick to those goals in that account. I said account an awful lot. And then my last thought on direction and everything else is everybody I hear on TV thinks that we're overvalued and has this fear of this big crash coming. Generally, everybody's wrong. That's part of why I'm still bullish. And my guess is when they all have fear, they all put cash on the sideline waiting for this crash to come. It has to suck everybody in. The markets have to go higher to give everybody that FOMO, to push all the money in, to get them to think, I'm wrong, it's just going to go higher and higher. And that's when it'll finally correct. I, and like I said, I don't know. I have mixed feelings. Part of me wants to say I'd rather see the market struggle and just be healthier. And part of me wants to see this unhealthy market shoots up and market comes back down. Now, last thing to pat myself on the back. I assume you guys saw Intel. You know, I don't think they're a wonderful company. The only point when I was recommending Intel is if the government is taking a 10% equity stake in it, with the administration that's in place, what do you think is going to happen to Intel? Do you think that they're going to struggle and go out of business, or do you think something is going to happen to make sure that they're profitable so that they go up in value and the government gets to pat themselves on the back and say, hey, look, we were right. It's a good thing we invested in Intel. My guess is the latter. And I think whether it's new contracts to put new computers in the White House or the Senate and Congress and everywhere else and potentially military, they could even call it secure national security that we have to use Intel products. And they might get tons of contracts from the government simply because they're going to push the stock price higher and make the company worth more so that we as citizens and taxpayers are now invested in it. It's not a prediction on I think Intel's great, it's a turnaround story or anything like that. It's really just to me a logical outcome of the agreement from the CHIPS Act that now we all own 10% of Intel. It's hard for me to imagine that the government does the CHIPS Act, they take a 10% equity stake in a company, and that company then flounders along. I'd also keep an eye if it happens with any other company. Anything that we end up taking an equity stake in, I have a feeling will do very well. I typically don't pay attention to government and politics and what goes on, how I think it would impact the stock market. But at least with this administration, they pretty much tell us. Now, I don't know if I'd buy it here. It's already moved. But the shares that I do have, I'm sure not selling. And I'm hoping that the thing shoots up to, I don't know, $80 or $100 over the next few years, which I know sounds so absurd because it was such a struggling company. But I really think we're going to see some things where it's national security reasons why we're going to have to use the computers that they make. And now that they have the NVIDIA chips and they're doing PCs, that it's going to be the best computers that could be used for the job. Just my thought. What do you guys think? I mean, does it make sense to you? Do you think it's just the worst investment ever? Or is that something that you think is worth a shot on something? Again, not financial advice. No, no, no. I'm just curious what people think about Intel and my analytics on it. Anyway, as always, if you haven't already, do me a favor, hit that subscribe button, smash the like button, make some comments in the comment section. I love the conversation. I may watch the rain and do some editing. I'm excited for tomorrow to see what the options expire, and I'm excited for the weekend. I hope everybody's doing awesome. I hope your portfolios are making new highs. And more importantly, I hope your family and kids and parents, that everybody's healthy and doing well. Have a great day. Bye-bye.